U.S. stocks rallying for a fifth week and touching new highs. But are investors pricing in the risk of an economic slowdown? Our next guest thinks that growth concerns are the biggest risk for stocks. Joining us now, we've got Tom Essay, Sevens Report research founder and president here. And so break down your thesis just a little bit more for us here. And if we were to see some of that volatility stemming from the catalyst that you suggested the markets are not pricing in, what type of volatility could that imply?
Good morning, guys. Thank you very much for having me on. Yeah, I think the market is complacent to growth risks. I mean, the S&P 500, as Sean said, is about to break 5,900 or may do it here while we're on the air. And at those valuations, it's essentially priced for perfection. It's priced for an ongoing soft landing, no economic slowdown, stable earnings, no deterioration in geopolitics. What it's not factoring in is that what's happened in the past happens again, whereby higher rates actually slow the economy. And I want everybody to realize that a slowing economy does not necessarily mean a recession. But where stocks are right now, if growth even slows to sort of flat or sub 1%, you could see a 10% drop on the S&P 500, and we wouldn't even be probably at fair value. So, look, things are good right now, but I do think the market is complacent to economic slowdown risks.
So then, Tom, what's your advice for investors? What should they be doing today to prepare themselves potentially for that downside risk?
I have been advocating for focusing on quality and lowering volatility. So we can do that with all the financial tools we have now. You can go to ETFs like a USMV or SPLV or a QUAL. And essentially what this does is it sort of bolsters your portfolio. Sure, if the AI craze carries the NASDAQ another 10% higher, will you lag on the upside? A bit, but you'll still participate. However, if I'm right about the growth fears, then you're not going to fall as hard as the rest of the market.
And so with that in mind, in some of your notes, you also say with rates high, you don't think that growth remains the single biggest risk to this market. What is the more outsized risk then?
Well, I think geopolitics could be probably one of the largest risks out there. I mean, we are not in a good geopolitical state, are we? I mean, we all seem to sort of not we're not focused on it here in the markets because it hasn't really impacted. But it can, and I think that that's a potential wild card that people need to worry about as well. And then also there's going to be a lot of political uncertainty coming out of the election because we're all going to be trying to game what policy changes are going to occur. All of these things can combine to sort of fracture this perfect window we're in the markets. And I'm not saying things aren't great right now, but we are in a pretty good state right now. But all I'm trying to do is remind investors that, hey, there are risks out there, and that this is the stock market can go two directions as well. We only seem to be focused on the up at this point.
And Tom, since you mentioned election there, what do you think volatility is going to look like? We talked a lot about the volatility that we could see here over the next several weeks leading up to the election day. What about right after the election? What do investors need to know?
Yeah, I think that the biggest thing is we look at the election. First of all, the worst case scenario is basically that there is no decision shortly after election day. And I think that investors, all of us as investors, need to hope for clarity, regardless of who you want to win. But if there's no clarity and we sort of get dragged on for weeks where we don't know the outcome, that's the worst case scenario from a volatility standpoint. I think they could easily take 5% or more off this market again because we're so richly valued. On the flip side, if we get one party rule out of the election, whether it's Democrats or Republicans, that's going to spur a ton of policy uncertainty as well. And I know that in the past, markets sort of have this knee jerk, Republican total control, good because lower taxes and growth, Democrat potentially not as good because potentially higher taxes. That's not the case this year. We have a different dynamic. The deficits and budget matter. And if markets view even one party or the other as blowing out the deficits, that's going to be a negative regardless of whatever will happen with taxes.